Hey, Mama Trades! We're going to do a trade review. My last video was a trade preview of what I'm going to buy on Tuesday. This video is a trade review of what I bought last Tuesday. So let's get right into it. What I bought on Tuesday, 10/15/2024. What I bought on Tuesday, not what anyone watching this video bought on any day or will buy on any day, because this video is for entertainment purposes only. It's absolutely not investment advice in any way. No different than if I want to go watch Travis Pastrana jump out of a spaceship and parachute from outer space into the ocean. That doesn't mean I should go copy that and book a SpaceX flight tomorrow. On Tuesday, I bought an 8% holding of PYPY, the yield max out of the money synthetic covered call ETF on PayPal, a 7.9% position in Ymag, holding the Magnificent 7, running the out of the money synthetic covered call, an 18% position in the Coinbase covered call ETF CONY, and an 18.79%, 76% position in the short Coinbase ETF FIAT. Whoa! So we're gonna have a lot to get into with those two, because those positions are going in different directions, right? Well, it was also paired, as you can see, very evenly with a 17.7% position in the MicroStrategy out of the money covered call ETF MSTY. I also bought a 17.7% position in RQI and a 9.7% position in another real estate, not a closed-end fund like RQI, but an ETF, SCHH, with a very low expense ratio. So with that in mind, let's get to the weighted average expense ratio. I took the size of the position, I multiplied the expense ratio, the relative size of the position, and then I multiplied the expense ratio to get the weighted average expense ratio. For example, with Ymag, the expense ratio is 1.28. It was 7.9% of this position. So I took 1.28 times 0.79. I got 0.10112. So that was the value for Ymag. The lowest one was SCHH. The expense ratio was 0.07. It was a 9.7% position, so I put 0.07 times 0.97. I got 0.0679. I added all of these values together. The only one that's a little funky is for RQI. I took the managed assets expense ratio, not the total expense ratio. I didn't include the leverage. I don't count leverage expense against closed-end funds because I can't get leverage for free. I actually subtracted that by the discount to the NAV. That's something that is very specific to closed-end funds because the shares are not redeemable like ETFs. We'll get into that. But the average weighted expense ratio was 1.008. That's nothing to sneeze at. And if we look at my goal of using SCHH to lower the expense ratio, it didn't even lower the expense ratios of the yield max ETFs. All it really did was lower the expense ratio of the RQI closed in fund and the Ymag ETF, getting that 1.28 and 1.54 down to 1.008. So that's the big devil's advocate. There are a few more devil's advocates with these yield max ETFs. We'll get into them, but that's the big one, 1.008. By my math, I believe, essentially, every $10,000 I spend, I'm going to spend $100 a year paying the fund managers. I don't think that's that bad. We're going to make sure it's very high compared to other options, like a whole suite. I could probably build a whole portfolio of just Vanguard ETFs and Charles Schwab ETFs. The expense ratio for that would probably be 0.1. It would probably be less than 0.1. So, but what would I lose? I'd probably have a much lower yield, less dividends per week, especially per month. Let's get into why I bought some of these. We're going to start with PayPal first. So the very first thing I always do, and this is really, I would say, is like if I was running a firm and we were hiring new young quants out of college or out of whatever, this is the very first thing I would ask them. I would ask them, what is the website that you use most often? Bar chart, I would have them list 3. If one of them that they listed was not the ETF total return calculator or some other type of ETF total return calculator, I would say thank you for your time. We're going to go on to the next candidate. PYPY, blindly averaged into 60% total annualized return. A lot of people will look at these and say these yield max ETFs are scams. The dividend is too high. This is 5 or 6 times higher than the average return for the S&P 500 on a total basis, not to mention the extraordinary yield. We did see a big yield jump with PYPY recently. That's another thing. This isn't the most consistent dividend. It's yielding 80%. So when talking about that expense ratio, what's being given for it, we've seen the dividend jump recently, and that's because PayPal itself has jumped. So I'm going to get into that right now, but we have seen a dividend jump, but still holding over $1, and we've seen that I'm going to collect that dividend as well. So I bought that dividend, and I had some pre-existing exposure to PYPL. This is my untouched chart. Again, look at this untouched chart of beauty. This red wave 3 perfectly being hit right there at the 161.8% extension. So this is my most recent work on PayPal. Beautiful. I said wave 1, ABC wave 2, 1, 2, 3, 4, 5. Another wave 1, ABC wave 2, and then perfect wave 3 of wave 3 up to the 161.8% extension. So I'm going to keep holding this. But what happened here is we can see as PayPal rallied, the dividend per share, the dollar amounts, not the yield, rallied. And that's where we're seeing this bloated option premium, this bloated covered call premium take place. And this is where being able to sell the out-of-the-money synthetic covered call options instead of buying the leaps, but being able to sell the out-of-the-money synthetic covered call options instead is so much more advantageous because the implied volatility spikes and the call premium rises to the upside. A lot of people on FinchWit will tell you implied volatility going up means that the stock is going down. That means that the puts are getting a lot of premium. That can certainly happen, but it can also happen the other way where these violent rallies start, and that's really where most of the money was made with NVDY for NVIDIA. It's where most of it's going to be made with MSTY, that upside call premium when these stocks get rallying. And I look at PayPal, I look at SCHH. PayPal, I've got the short-term chart out. We've hit this wave 3 target. I'm not selling PYPY, and I expect that actually we're going to see continuation. This is what I've had for PayPal. We hit that perfect red wave 3 target. I talked about why I'm buying SCHH next week, but it's also big evidence for PayPal obviously being very closely correlated. This is the long-term chart. Wave 1, ABC wave 2, another wave 1, another wave 2, and from this low, another wave 1, another wave 2. I know it sounds like a lot of wave 1 and wave 2s, but that is specifically what I look for. And there's a whole host of stocks at that equal legs target right now with, SPY near 600. We're not seeing a lot of laughs about 1-2-1-2 Elliott wave nest. You don't see many of those comments about how everything's a nest. Yeah, people were telling me everything's not a nest in early 2023 and late 2022. Actually, everything did end up being a nest, and all those people just deleted their accounts. So anyway, this is the more, I'm going to buy SQY. I want to buy SCHH as well, the commons. That's also going to lower the expense ratio. But here's some supporting evidence for PayPal. Shopify, again, very beautiful. This is the whole sector, and it's glorious. So I think one day, yeah, PayPal is going to be above this high. So is Shopify. So is SCHH. Very beautiful. And PayPal and SCHH both having these ETFs come out. People have said that I'm nuts for saying this, but look at where these ETFs dropped for PayPal and SCHH. Wow, another super cycle low. They keep getting lucky. 1, 2, 3, 4, 5. Large wave 1, ABC wave 2. From this low, another wave 1 and another wave 2. I know the people who dropped GOOY, that ETF. They can't possibly be doing Elliott Wave, right? Right? Okay, well, another wave one, another wave two. And wow, it looks like Shopify is within wave three of wave three, going perfectly, just like PayPal. So we'll move on to the next one. What was the next one? The next one was Ymag. Ymag. There's so many. All of the Mag 7 is in this. What I love about this ETF right now is we look at the Ymag holdings. They're all in completely different spots. And for this type of ETF, selling the option premium, that's what I love. Tesla, the laggard play. One, ABC, two, another wave one, another wave two. I suspect we hold Personally, I suspect that we hold this low of 182 flat, and we're going to go into wave three of wave three. Now, with that being said, remember, I've kind of gone off recently, just there's no other way to say it, and I found a way to get a 15% total annualized return delta neutral from Tesla. And I invest in this pretty heavily. I make money on this pretty heavily. TSLP blended with CRSH together, positive total returns, blind on Tesla, not picking a direction. Holy cow, super cool. I also own TSLY. Let's just see. Whenever I do an ETF, I don't tend to do it exactly from when I started buying it. I just want to see a few things. The biggest one, what happens since inception, blindly averaging into this ETF. We can see TSLY did need to be averaged into. But let's look at this. This is some pretty basic information, I would say. But how useful is this? Just comparing TSLP to TSLY. Let's look at this. Blindly averaging into TSLP since inception, 12.82%. TSLY, very similar strategy, but it's a little different, negative 8.41%. The Tesla is the same. The Tesla bull bias is the same. The ETF is what's different. That's why this has to be the number one. Website for every trader, or you're getting out of my place. Let's look at some of these other stocks in this Ymag ETF. The big problem with the Ymag ETF, the big problem is the expense ratio is pretty high. Just objectively, the expense ratio is pretty high. It's 1.28, and yeah, it's 1.28 for Ymag. What happens when blindly averaging into Ymag, though, is very cool, especially now that it's a weekly dividend. It's 23.53%. Comparing that to SPY blind for the exact same time period, SPY is a little better at 30%. Actually, that's not the exact same time period. We can get the exact same time period right now because that took off 4 days. Let's see, 30% versus 23.25%. So SPY is losing to Ymag a little bit right now. Wow, it's at an all-time high. I'm pretty sure it's not losing to XDTE. XDTE is still kicking SPY's ass, but that is a different time frame. So we go into the same time frame. Very similar. But XDTE is giving a massive dividend and paying it out. It's actual real income. We look at some of these other stocks in Ymag. Google, very high, climbing that ladder. Apple and NVIDIA. NVIDIA is very high. Apple is more of one of those stocks that's in the middle of things, so to speak. It has a little more upside. What do I mean by that, by the way? Just more perfection from Apple. I actually think from this low, wave 1, ABC wave 2, and this is another wave 1 and another wave 2. Why do I think that? We look at this RSI. We usually get a higher high on the RSI. We get a higher high on the RSI for wave 3 when it's a lower high, and we have not a wave 4 retesting the wave 1 high, but a big wave 2 breaking the wave 1 high. It's not going sideways, it's real fast. This looks like a wave 2. It looks like Apple could be beginning wave 3 of wave 3. I believe Apple is also in the middle of things, so to speak. What do I mean by that? The most important thing probably for the rest of these Mag 7 stocks for the purposes of this video is to understand if we take this 2020 March low and we connect it to the high from January of 2022, Nvidia has reached the equal legs target. It's blown past it. Microsoft has reached that equal legs target. So we have a whole host of stocks. Facebook has reached that equal legs target. We have a whole host of stocks that have not. Apple and Tesla are some of the ones that are in Ymag. I don't believe Google has reached it either. So anyway, Ymag, I mostly buy it for the total returns and the idea. We haven't quite seen SPY hit the equal legs target yet, but there are other stocks and ETFs in Ymag like Apple and Tesla that, in my opinion, they've got a lot more upside playing catch up to Nvidia and Microsoft. Google, I would throw in there too. On the flip side, because there are these big winners in Ymag, like Nvidia, like Facebook, the premiums on those ETFs are super, super high, like Netflix as well. That's why we're seeing an extremely high yield. I'll be the first one to tell you right now, the yields that Ymag is giving on a weekly basis, the yield that Ymag is giving is enough for, and this is Ymax, but the yield that it's giving on a weekly basis, I can't see Ymag right now, is enough for, if they were just paid on a monthly basis, that yield to be super, super high. So anyway, that's Ymag, CONY, FIAT, and MSTY. All three of these are going to be together. The first thing to understand for Coinbase, is that I have a winning position on Coinbase and CONY, and my CONY position originally has already paid for itself. I also have that exact same thing going on with Bitcoin futures ETF BITO. What I'm looking for out of Bitcoin is that this was a wave 1, 2, 3, 4, 5, large wave 1, wave A. This is an ABC wave 2, a wave B, and Bitcoin BITO will hold 16.11 and will enter wave 3 of wave C. The length of wave 1 placed at the wave 2 low can take Bitcoin up to BITO up to 40, and it's going to pay a massive dividend along the way. Speaking of ETF total returns, this is the big reason, one of them right here, and there's plenty of examples like this, why dollar cost averaging is not about buying the dip the next day. It's about buying the dip on an interval, a time interval, not a price interval, averaging in over time. Blindly averaging into BITO at the peak, at inception. Let's try that again. Blindly averaging into BITO right here has given a total return that destroys the S&P 500. Huh? I thought that wasn't possible. How is it even possible for someone to start buying the dip and accumulating the stock right here? The stock is down here, and the total returns are actually incredibly impressive because it was blindly averaged into over time. And when stocks bottom, ETFs bottom, they do it with long bases that take a very long amount of time. So that's why dollar cost averaging over time is the optimal way to take advantage of volatility instead of having volatility screw you. And we can see that's getting back tested for the buy. Anyway, BITO was in this range for a long time. The accumulation campaign still continued, and this stock pays big dividends from Bitcoin futures, front month futures during contango. Another reason I'm excited about Ethereum and EETH. No, not ETH, Tether. Who uses Tether? Does anyone even believe that Tether is going to work? Anyway, yeah, Ethereum getting started, looking very good. Gorgeous 1, 2, 3, 4, 5, wave 1, ABC wave 2, another wave 1, ABC wave 2, wave 3 of wave 3. So that's some Bitcoin and Ethereum analysis. I'm looking for above 2154 for Ethereum. Coinbase bottoming out, looking very good. This is what I have for Coinbase. We are in an ABC correction. I didn't sell any CONY. I actually think we ended this ABC correction. I didn't sell any CONY. I told you guys what I was going to do instead. I bought Fiat with CONY because I had already bought CONY here, so it had already paid for itself by here. I kept collecting these premiums, and what I think is happening is that this was a large correction. This was an ABC correction ending between the 50 to 61.8% retracement. Now, this can be labeled as a wave 3 and a wave 4, or it can be labeled as another wave 1 and another wave 2. In my opinion, it doesn't really matter because wave 5 is either the length of wave 1 or it's the length of wave 3. If it's the length of wave 1, it doesn't make a new high. If it's the length of wave 3, it's the same thing as saying this is wave 1 and wave 2 because the equal X target is going to be the length of this rally, place of this low, taking Coinbase up to the 380s, possibly higher than that. Looking at this RSI down here, 82.60 is the weekly high to break. The monthly high to break is 64.69. If either of those go, that's going to confirm this is a wave 1 and a wave 2. Big wave 3 of wave 3 in progress. So that's going to be the technical side. We're going to get into some quantitative stuff now for those three stocks. MicroStrategy I've gone into a bit, but what we're going to do, I've talked about the correlation of Coinbase and MicroStrategy together. MicroStrategy is outperforming Coinbase, and they're about, they're pretty correlated. Only about 36% of the portfolio is diversified away when investing in MicroStrategy and Coinbase over the past 3 months, according to Macro Access. So there's not much diversification. In this case, that's actually a good thing because when I look at Fiat, what it does is it shorts Coinbase. So the idea is to go delta neutral on Coinbase. I already have a big winner on CONY. So I started taking a new delta neutral position against that. It was half Fiat, half CONY. We see the total returns for doing that are that Fiat turns $30,000. It makes actually $4,184. It looks like we're going to be a little roughed up by this calculator right now. We're not going to get to see, unfortunately, the total returns. That's probably the downfall of using free stuff. But we see right now, CONY, it turns $40,000 into $46,224 from 7/11 to 10/18. So it makes $6,224. Fiat loses less than $6,000. So one ETF makes more than $6,000. One ETF loses less than $6,000. So it's a marginal return, but it's delta neutral. The point is, because I already have a winning position on CONY that I didn't sell, it's actually still a bull bias position. Fiat is just hedging, and I am blending these positions with MSTY, which I believe is going to beat Coinbase and be correlated with Bitcoin and Coinbase over time. So it's basically the idea of a pair trade. The pair was long MSTY with delta neutral Coinbase via Fiat and CONY. The real thing is to collect so much premium from Bitcoin, and then the same week as MSTY, which is after Coinbase and Fiat's ex-dividend date, the Ethereum buy right ETF YETH and YBTC have their ex-dividend date. Hallelujah. Let's look at these total returns, blending them together. $40,000 turns into $54,000, so it makes $14,000. So the idea is that by combining MSTY, Coinbase, and Fiat, one makes over $6,100, one loses less than $6,000, and the other one makes $14,000, $15,000. So the idea is to lower the risk so I can scale this a little more. I'm going to buy a big dividend from MSTY. I'm going to be a very happy pup when that is declared. RQI and SCHH, I've gone over the technicals so many times. It's really more here about understanding the expenses. Managed assets expense ratio. By the way, what's the deal? 3.99% common assets expense ratio. The managed assets expense ratio is 2.79%. The way that I interpret this, and I could be completely wrong, I'm not a certified financial advisor, is that a closed-end fund is using leverage and it trades at a discount and it trades at a premium because the shares are not redeemable the way ETF shares are redeemable. So it trades at a discount and a premium and it uses leverage. So because it's using leverage, higher expense ratio, but also there's a leverage expense ratio. Leverage is not free, so the fund passes some of that expense on to me. So do I hold that against the fund? No, I don't hold a leveraged expense against the fund unless I think I can go get a free borrowing fee. Unless I think there's a bank that's going to give me free money and let me borrow with no expense ratio, no interest at all, then I'm not going to hold leveraged expense against the fund. So I don't count leveraged expense because I can't get leverage for free, so I assume the fund can't either. So I only count the managed assets expense ratio. What I did was I actually lowered the expense ratio. The reason that I did that is because we look at these closed-end funds right here, and we see that RQI is trading at a 1.54% discount to NAV. It was even higher when I was buying that. So I was using that discount to NAV as justification I was going to make some money. Now let's justify paying for our RQI's expense ratio at all. RQI and SCHH are going to have basically identical charts, very beautiful, and I've made a good amount of money on this. 1, 2, wave 3, highest high on the RSI, shallow wave 4, wave 5 ends with momentum divergence, A, B, C correction. Look at these time fibs. The whole length of wave 1, wave A, was exactly where wave 2, wave B ended. I wonder where wave 3, wave C is going to end. Hint, hint, August 2025. Already looking for a September quad witching in 2025 to be nasty. Anyway, I think we're within wave 3 to 21.83. SCHH, exact same, except very low expense ratio, which I went over before. Let's make sure we understand why the RQI expense ratio is justified. Blindly averaging into a non-closed-end fund without leverage. VNQ is kind of the benchmark, a 7.6% total annualized return. Looking at RQI, in the same time period, we're going to get a 10.75% total annualized return, dramatically beating basically the exact same benchmark using leverage, being a good closed-end fund.